Hi, good afternoon to all. I think the topic today that we have is relating to international taxation, and it's a topic that needs to be done before lunch because post lunch it'll be very taxing. The kind of twists and turns that are happening today in international tax, it's a very vast subject. We'll try to cover whatever is possible within the time allotted, which is around 35 minutes. I'll just give you a brief in terms of what is happening in the international tax arena in terms of the issues, and then anyways we have a very experienced panelist who will address the questions one by one. There are from an international taxation perspective, whenever you have cross-border transactions, there is going to be an issue of who is going to tax which streams of income, how it is going to be taxed. Then you had issues in terms of digital economy. Then we had the base erosion and profit shifting issues that came because people were doing tax planning in terms of stashing incomes in low tax jurisdictions. So you had BEPS coming in, then you had various other taxation as part of BEPS action plan itself. We had various other taxation plans. They were probably interest restrictions that came up as part of the action plans. Then you had today, if you see the kind of interpretation issues that we are having in international taxation, be it we had from a PE issue, we had a Formula One issue where they said that if you're running a circuit Formula One race that is there, that place is a fixed place PE, and therefore all income to be attributed to that place and profit is attributable, and there is a tax payable on that, where erstwhile we thought it is not there. So whenever things travel to the Supreme Court today, the international tax community as well as the Indian tax community are perplexed. We are kind of very, it becomes very uncertain because today we are talking about a most favored nation clause, where erstwhile we thought MFN, the moment it is notified in the protocol, automatically it should be applied. Today at the Supreme Court, they've said that you'll have to issue a separate notification, and therefore now applying MFN has become a big question, and we are facing a lot of things. So the previous panel was talking about AI in taxation and cross-border taxation. I think it's impossible in India because what is going to happen tomorrow, you don't know. The Supreme Court will absolutely turn things around. So you have issues today in TRC that is going on in the Supreme Court, where they said that, so today to fix a residency of a person, there is a tax residency certificate that is a base document that is required. So today we thought that that is more than enough sufficient to provide for a tax residency. Today there is a case that is going on in the Supreme Court to say that should we go behind the TRC and look at who is the beneficial owner and to which country he belongs. So is it the end today that we take a position today it's going to be finalized? No. Today, if in international tax, every day is evolving. The moment something goes to the Supreme Court, you don't know the outcome. It could be in your favor, it could be against. So from a MNC perspective, from a tax reporting perspective, can you say that the litigation is over today? It is not over. It keeps going on and on and on. So that is the situation there. Then you have other issues in terms of today, Europe is trying to levy a carbon tax, which is again going to be an issue as far as cross-border transactions are concerned. It is going to create a lot of issues. You have indirect tax coming in and saying and bringing tax on guarantee today. So they're saying that you'll have to deem it at 1% even if there is no guarantee that is being charged. How is it going to play out from a transfer pricing perspective is another issue. So the issue is galore, and if you say whatever you're trying to automate, etc., it can work to some extent, but the kind of twists and turns that we are seeing today, there's nothing that you can actually predict or do, except that from a taxation perspective, you know that there is a lot of integration that is happening in terms of direct tax, indirect tax. You have, and the moment you file a return, your turnover gets checked with what you have filed in the GST, and immediately there is a query that pops up. Today you have innumerable questions that are there. Your PAN is linked with your for rent. The moment there is at least few thousands of letters that have been issued to individuals, this time for salary payers, for in their tax declaration for relating to HRA, etc., so on and so forth. So all these are AI and tax data analytics that are playing a big role, but apparently that's how tax is evolving today, and we will probably I'll just ask the panel to introduce themselves quick 2 minutes, 1 minute introduction the panel can do, and then we'll start off with the questions.
Thanks a lot, Sridhar, for setting the right context. So myself, Krishna, and I represent an organization called Avalara. So we are a tax technology automation company. So while we also do a little bit more of an automation and we deal with quite a lot of companies, so we also want to share some of our experiences of companies where we could really transform their taxation journey. And I completely agree with what Sridhar has mentioned about it. It's we just in the horizon. There is a lot to come from an automation and taxation perspective. I'm looking forward to hear a lot of interesting thoughts from our co-panelists and the esteemed speakers here.
Thanks, Sridhar. Good afternoon, Chennai. This is Rahul Barve. I'm head of the tax at Zenith Limited. I have experience of around 23 years across Big Four and now 8 years into industry. So I would like to share my thoughts and would like to also hear from you. It's a good learning for me as well, from all my co-panelists as well as from my moderator. Thank you, Sridhar.
Good afternoon, everyone. I'm Vasudevan from Chennai. I represent Raj Petro Specialities. It's a Brenda Group company. We are into manufacturing sector, and I'm hoping to learn, during the sessions.
Hi, I am Parameshwaran. So my company's name is Servion Global Solutions. What we do, we are a niche technology company who develop applications for the contact center sector. And I have around 12 to 13 years of experience in taxation. I head both the direct and indirect tax verticals at Servion. I'm looking forward to hear the thoughts of the panels. Thank you.
Thanks everyone. So we will start the question answer session, and I will start the question with Rahul. Rahul, just give me an overview in terms of what are the primary challenges that are being faced by multinational enterprises when they are engaging in cross-border transactions, specifically from a taxation perspective.
First of all, as a disclaimer, being a listed company, my views are personal in nature, and it may or may not be of my management. It's purely a personal discussion which is happening over here. Thank you. Coming to a question, I think MFN was a nuclear bomb, right? Which everyone got.
Absolutely.
The biggest mistake which we all do in tax is we don't prepare a risk passport. And what is a risk passport? We can't basically time an unknown, but we can certainly time something which is there as a litigation factor. MFN was never tested before the authority in the past. I mean, it was tested at lower levels, but not at a higher level when Supreme Court has taken up this matter. But some of these aspects, can we not bake into the project cost itself? I mean, we can preempt based on our experience, what can go wrong, what is going right. May not be in the full entirety, but in certain aspects where certain things can be baked in as a part of the project cost. And I can understand companies like distribution would have a margin of 2%, APC would have 5 to 7%, there could be software between 15 to 20%. So it depends on industry issue, how can you bake, those costs will go up then, and customer may not accept the product. But these are the aspects which we should upfront plan, upfront at least highlight to the management that this could be an issue and this should be baked in, or somebody has to absorb that cost at a certain point of time. In terms of international cross-border transactions, I think the main aspect is who's going to take the primary contract, right? Is it going to be the Indian company or is it going to be the foreign company? If it's an Indian company, obviously you'll have issues in terms of your RCM GST has to be discharged whenever it's applicable. If it's a foreign company who's going to take it, transfer pricing comes into play. What margin should be there at India level? What margin should be there at intermediate company holding level, whether it's Mauritius, it's Singapore, or Netherlands, wherever it is. Also, in terms of doing business overseas, how do you plan for the foreign tax credit, right? Some of the credits are not fully available. Only on the margin you get the credit in India. So there is a credit which lapses. So how you upfront bake in that as well into your project? That is something which you can intelligently do at on day one itself, right? Wherein maybe your partnering business, you can't tell the business that, you know, the show will not go on because there's a hit to the business. But yeah, certain calls can be taken, you know, certain calls can be conservative, certain can be aggressive as well. That is the way I think we should look at from a cross-border perspective.
Perfect. Krishna, can you throw some light on this from a retail perspective?
Yeah, when it comes to the retail, Sridhar, you know, what we've observed is, you know, there are a couple of more factors which gets into the play. One is more about determining the law of the land, and I'll also echo with Rahul's thoughts over there. It is also important, like, you know, who is getting into the contract, and many a times a cultural shock. I'm trying to take the standpoint from a US perspective because it's a little different than the rest of the world. When we really look at companies trying to do business in countries where VAT or a GST regime is in, so the concept of credit is managed as whether it can be VAT credit. We call it as an ITC over here, they call it as VAT credit. But when people try and do business in US and they try and want to apply the concept of credit, so the regime is built in such a way there is no concept of credit at all. That's a cultural shock. And this happens significantly both with services and even retail companies. But the retail companies take it much more, the effect is quite big for them because, you know, they would try and establish a player over there who would again in turn resell or redistribute and other things. So the problem starts with determining are they really hitting the right de minimis thresholds, are they keeping a tab on it, and accurate HS code determination and the local taxation. And what we've also seen is in a recent example of a fashion brand, we are masking the name obviously for the basic reasons. So these people were doing business since 2012 in US alone and above 16 and all from quite a lot of other countries. And they were unaware that they need to levy the tax and on the local tax per se. And the concept of nexus, which is more crucial when it comes to the US. So they weren't even aware, and they've breached nexus in almost close to 28 states out of the 32 they are operating. And now if they want to do a back calculation and figure out what's the liability is, so the liability is hitting around close to $2 million. And that's really a cultural shock for the CFO because he has to face the investor community, the board, and he is in a extremely weak in a position over there. And I think it's important that companies should also start looking at some kind of, you know, introspective studies, which is available when it comes to the US. You can still do an excess study and other kind of studies, but in other countries also just to keep a tab on how the taxation rules are changing. And needless to say, it's uncertain in every country. It's not just in India. So probably I'll just take the horizon a little bit more. It's the same across the globe from a loss perspective.
So very, very true, because see today from how do you want to actually plan for the tax cost is becoming very volatile, because suddenly now you have this MFN issue, then your local withholding tax rates for royalty and FTS as far as cross-border got increased to 20% from 10%. Was there a logic? No. Was there a logic for 10%? I understand that there was a logic for 10% in terms of, let's say, 30-35% of gross margins, and 30% of tax on the gross margins worked out to around 10%. So there was a logic. Today, are we saying that there's a gross margin of 70% for people to levy tax at 20%? No. So if that is a thing, and with MFN also coming in, so you don't know how do you plan for taxes at all. So it's so volatile. And at sometimes you kind of left gasping for logic in terms of when such shockers come. So we will kind of touch upon in terms of let's say reporting and documentation. I'll go to Param. What role does reporting and documentation play in terms of this international tax compliances, and how can this process be streamlined? Because ultimately, for all these transactions or wherever, the underlying is the documentation that we need to be careful about.
Yeah, so like you rightly said, that is the most critical aspect. You as a tax professional, you can help in the planning You can suggest your views as to how this should be done and what should be the risk we should take. But ultimately, when the transaction is implemented or when a form is being filed, what is the underlying document which you need to support whatever you are getting filed is the most critical function in an entire tax process, if you ask me. So let's take an example where, let's say, a US entity, your group has a US sub or a US holding. They are making a payment outside US to another customer, or sorry, a vendor. If you don't have a form, if you don't collect a form W8BEN-E from that particular vendor, then and if you miss to do that, then you are exposing yourself, you are exposing the company to a 30% tax because you didn't collect that particular form, which otherwise would have been zero withholding if you had collected. So that's the kind of fluctuation of as far as taxes are concerned, where you miss to file, where you miss to collect a particular document for whatever be the reason. So if you ask me what should you be doing as a company, I think simplest is to start with the basics, have an SOP as to what all processes and the particular organization has in terms of tax, whether you are part of the process or not. Let's say a vendor, you may not know when the payment is made to a vendor, but as far as the process is concerned, that person should be educated to ensure that a Form W8BEN-E is collected. So having an SOP helps a lot, because ultimately you can go, if tomorrow you are questioned, you can go ahead and say, see, this is the process, you didn't follow it, or you were supposed to follow it, or there's some lapse in how the process was being followed. So that's, I think, very critical. It's just basic housekeeping to have SOPs for main processes, and trying and educating the people within the organization to stick to that. I think that's the largest challenge which we as tax professionals face within the organization. Second is, you have to ensure that, let's say, so recently I came across a scenario where Singapore usually had a 7% GST rate earlier till 21. So what they did was that from 22, 23, they changed it to 8. And 23 onwards, it's become 9%. Now, so again, there is a transition here. And when you go through a transitionary phase as far as a rate change or a process change is concerned, then you have to know the guidelines. So Singapore is a much more easier jurisdiction to deal with, as far as it's a personal opinion there, because they beforehand they give out the circulars, they give you out guidelines, and all you need to do is just stick to those guidelines. So again, when you do that, when there is a change, or so let's say a PO was raised in December, you are invoiced in January 1st onwards. Will you give a 7% rate or will you give an 8% rate? So those are the topics. So when those questions come to you, you should know that, see, this is the rate which you should apply. But again, as a tax professional, the largest question, again from a documentation perspective, is that we in a cross-jurisdictional organization, we have no choice but to deal with tax consultants. Now, the level of accountability you rest with a tax consultant depends on how you work. So let's say you have an organization, you have exposure in Thailand. Now, Thailand is a place where English will not work. Even if you know English, it doesn't work. You don't know the language. And okay, let me give it to you with an example. So what happened for me was, there was an exemption which we used to take in Thailand. It's similar to an SEZ which we have here. There it's known as BOI. What happened was one day the consultant came across and said, "Sir, your tax exemption is no longer applicable." I said, "Why? We had 1 more year. This is the last year, right? We are supposed to get." No, we had a scrutiny and we had an audit, and the department observation is that there was one criteria for employee hiring, which was you didn't satisfy it for 1 year, therefore no. And unlike in India, where at least SEZ, if you have an SEZ exemption, it lapses from the year. Even if it is dispute, it's not retrospective. Here it is retrospective. So then I was shocked. I was like, what is this? How can you come to me and say that my BOA exemption is gone? So then your challenge is, how do you communicate? Is there an appellate mechanism? And on the ground, what kind of support is needed? Do you need from the consultant to get it done? Of course, we got it done finally. All those issues got sorted out, and we were able to convince. But in a cross-border scenario, you have to ensure that there is somebody there. While all this talk about AI and all this, of course, we are moving towards that. But from a process perspective, yes, AI plays a very important role. There's no two ways about it. It's just a matter of time, like many of these people were saying. But from a tax perspective, unlike India, which is miles ahead in terms of processes of how e-assessment and all, many systems are extremely ancient. So you need the personal touch there. So that is again a documentation perspective. You should ensure that you are in sync with your consultant to ensure that your documentation is crystal clear.
Thanks, Param. And we're talking about documentation and cross-border transactions, and transfer pricing cannot be missed out as part of this. Because that has been one of the biggest issues that are there today, even though today we have APAs, etc., which have kind of brought some certainty. But again, I would like to ask Vasu in terms of how can MNEs actually establish and implement an effective transfer pricing strategy to align with their international tax regulations?
Okay. The first step is to define the TP policy. So that will be, that policy should be aligned to the company's overall business strategy. Because every company, some company may not have it, but it's very crucial to have the TP policy. And in case if you are part of a global network, the TP policy should align not only with your company's strategy, but also with your global group transfer pricing, policy document. That's very important. And when defining the TP policy, you should also take into account various parameters, including the legal framework that is applicable. So that should go into the TP policy. So once the policy is defined, the next step is documentation. So that's very, very important, because the comprehensive TP policy should be supported by the contemporaneous documentation. Once these two are available, the next thing is where you can take your consultant's help. So what is that? You need to do a functional analysis. Do it as detailed as possible. Like what is the risk you are going to take and what is the risk the other entity is going to take. That is where you need to do a functional analysis. In some companies, they use the term as benchmarking analysis. Even before you enter into a particular transaction, you just foresee, what should be the transfer pricing methodology that you should be using, what should be the arm's length price indicative range that should be applicable to a particular transaction. That benchmarking forecast analysis should be done, including the functional analysis, which is a very important aspect of it. And then you do a comparable data. So what are the data you're comparing? Because when you are defining a transfer pricing policy, you should be having some set in your mind. And when you do a benchmarking analysis, you will have some data in your mind. And when you document all that, you should ensure that I am referring 1, 2, 3, 4, 5. So that is very important, because after a few years, if transfer pricing authorities come back and say, like, I will rely on, not 1, 2, 3, 4, 5, rather 6, 7, 8, 9, 10, at least we have some data point in hand to justify, like, what is that, we are relying upon. And once those things are available, it's very important to do the risk assessment to mitigate, if at all there's a requirement, we have APA, which Sridhar touched upon. Like, we need to see if at all we need to do for any APA arrangement, or whether we'll wait till the assessment comes in. So that risk assessment evaluation should be very clear even before we do the transactions. And then this is not sufficient. We should also have a proper internal control mechanism to keep on tracking, like whether everything, whatever we have defined as a TP policy, whether whatever we have documented, and then the analysis what we have done, and the functional assessment what you have done, so everything is properly, controlled, and it's commensurate with the business strategy or not. Finally, we need to do a periodical review. It's not sufficient, like, you set a TP policy that is aligned with the group policy or company's policy. Periodically, say at least once in 3 years, once in 5 years, it's worth taking the effort and cost to ensure that the TP policy or the benchmarking analysis is up to date, particularly when you have the trademark license fee, etc. So you cannot submit to the officer like the analysis which was done 8 years, 10 years ago. You should have something which is reasonably latest. I'm not talking about the TP updation study or 3CEB at all. I'm talking about everything before. I'm not talking about the postmortem. I'm talking about something which is in the planning stage. That's how companies can do that.
Thanks, Vasu. And yeah, please.
I'll just add to
Yes,
what
yes.
Vasu said. Okay, I think in the corporate tax world, the most beautiful law is transfer pricing. You have 3 lifelines over here. One lifeline, if you're a listed company, go to audit committee, take the pre-approval as per the Companies Act, whatever, section 188, 163, whatever it is, 177. Second stage, year end. After the year end, again go back and check your benchmarking, whether it's proper or not, whether margins are in shape or not. Third lifeline is when you file your return. If that is also missed out and you are not a tax professional, then leave your job and do something else. Most beautiful law in the world, right? 3 times you can do your checks, and still you can then see, I mean, things can go wrong in future as well. But you have those kind of avenues, windows available. Secondly, before going to the consultant, form your view. Do your own FAR. I mean, your risk analysis, your margins, you should first have your opinion, then let the consultant give his view, and then you can try and see where, are you going wrong, are you in the right direction or not. Don't only rely on the consultants. That's my limited point over here. Third point, even in transfer pricing perspective.
In just a minute, and that's coming from a person who has a Big Four background. So,
So I've seen
So
both
I
the
should-
words. I've seen both the words, so obviously, yeah.
so I think myself, Vasu, and Rahul, I think we 3 have a Big Four background. So relying on consultants is not the great thing. You need to have your own set of checks and balances, and your consultant is there for your risk mitigation and not
Right.
for the company.
So just last point to add before closing, I think one of the points which normally as a new professional, if you come into an organization, is told that this is the methodology you followed for so many years, why you want to change it? Please change it. There should be always a change management. You should look at things in a different way. People will come and tell you that this method is accepted by TPO for last 7 years, don't change it, next year we'll have an adjustment. Let it be. Can you not fight it out? But if that methodology which is selected is not right, or there are any flaws which you have to then go and plug in, please do it. Nothing wrong in changing the method. Obviously, you should have proper documentation to support that methodology what you're going to use. But I mean, I'm saying challenge the constant, always.
Perfect. In fact, live example, when I came into Siemens Gamesa, the first thing I did is there were certain cross-border transactions in terms of management charges. Those were not management charges, but they're classified as management charges. I said that let's not give a generic term of management charges. Let's see if these needs to be taken to technical, or if there is something related to IT, let's break it down to IT, let's break it down to the level of services that we can, and put it in different clauses, so that the moment you classify, because we are talking of huge numbers, and when you say the whole amount is management charges, immediately it raises an antenna with the tax authorities, and they say that it's only a profit shifting mechanism. Then you have a bigger fight to actually take on with the department. But when you say that if a portion of that is technical services, so technical services are generally not questioned, because everyone knows that today the department is sane enough to understand that even if you get a technology, pay for technology for royalty, you still need to pay technical service for how to use the technology, because both are very different. Just that I have the technology doesn't mean that I know to use the technology. I need to get some guidance. So to that extent, there is a understanding today that a technical service should be allowed. But when it comes to management services, they say that you have a same set of team, the whole team is here, why do you want to again go for a support? There you need to have the documentation. So the documentation is very important in that front also. Thanks, Rahul. And I thought I'll again come back to you, Rahul, in terms of, we were talking of documentation, and can you just touch upon the tax credits, and also what can businesses learn from the experiences of other in terms of others in the taxation front?
So there is also this controversy of TRC versus 10F, right? Now 10F is all online. Now Dubai, I understand they don't issue TRC in advance. Now they issue after the year end. So how do you take that call? Today he's a tax resident. You have TRCs for the past. Whether he'll be a tax resident, he or she or it. For next financial year, we don't know. But that's a judgmental call depending on the pedigree of the client, vendor. You need to see how the vendor is. Are they, fly-by-night operators, or they are, having a kind of a good standing in the market? Not just to take a call. Have the indemnities letters in place. I mean, that's where you normally look at. Secondly, all this controversy which started after the software Supreme Court judgment which came, where they said no withholding on the shrink wrap software. Two big issues cropped up. One is from an e-com perspective, whether e-com levy would still apply or not apply, right? That was one of the aspects. Secondly, has anybody seen under FEMA, when you do this form, whatever, A1, A2, when you do the remittance, and we are calling software as goods, FEMA doesn't have that provision at all. We are still using that old royalty route, saying no withholding, and we're remitting it. But for goods, they have to cross the custom border, right? Here the goods are not crossing the custom border because it's not a physical software, it's coming by a link. So these aspects, small things, but you need to think through, Secondly, foreign credit. There is a profit earned in, say, Singapore, anywhere else in the world. Credits are not available in India to the full extent. It's only on the profit margin which you earn. Business have to bake in that cost.
Correct.
The biggest, I would say, way out, business will say, I'll gross it up, but gross it up for at whose cost? Not your cost. It's not a finance cost, it's a business cost. The CEO has to answer that cost, right? It's not a simple, so make sure that business collects all the documentation. No P certificate, 10F, TRCs, any other thing which you want to collect, please collect it. Educate the vendors. I mean, take them through the process, but don't leave it. You got nahi hai life. This is a big risk which everyone is taking over here.
Speaking of foreign tax credits, just a quick 30-second. What happens is another issue is that you identify the credit as already, the deduction has already happened. Now it's your responsibility, let's say in India or outside India, to take the credit when you file, because wherever the income gets taxed. Now the documentation to prove that the deduction has happened and the credit we are eligible to take is another challenge. One is on the TRC and the remittance. But the other cases, okay, the form which a particular jurisdiction uses may not be acceptable in India. They may not have a form 16A, which is what we issue to our domestic vendors. There may not be a similar form. What they will give is that there is a letterhead, these are the remittances, these are the tax which is deducted, this is the amount. So you have to match that amount with whatever the credit. So that is something which you need to go and convince to the tax officer. So that's another issue which we usually find as far as documentation is concerned.
And one more issue in terms of tax credit is when your tax year is different from the overseas tax year. So that also creates a challenge because we have a April to March. For us, there is an October to September for our parent company. So, and for many, it's a calendar year which is Jan to December. So there's so much of kind of differences in terms of financial year which can create a lot of issues in terms of claiming the tax credits. And Krishna, just I'll come to you in terms of any specific examples in your organization in terms of.
So I have a couple of examples which we can really talk about, and probably touching upon what Rahul and Param talking about more from a consultant perspective.
Right.
So many a times, the local consultants, whenever I'm trying to take a view more from an US taxation standpoint. So many a times when we really talk about local consultants, almost 75% of CPA qualified consultants in US, they are not aware of sales and use tax.
Okay.
So they would confuse between federal tax and sales and use tax. And there are scenarios where we have seen customers who were given a kind of an input. I'm trying to do a digital services, and what kind of tax am I supposed to levy to my customers? So you just go and apply sales and use tax. But as such, they are supposed to collect communications tax, which is completely different.
Okay.
And the kind of penalty which comes back is we have seen Indian companies getting penalties as good as 400,000 from one state. So this all happens because of the non-cognizance, and two, most important thing is we need to have a eye out to looking at various geographies and other things where you're doing it. But needless to say, it is humanly impossible for a tax director or a head of tax to really watch out for every geographies and keep a tab on it. Else, he has to have an army of people for every country he or she is serving into. So that's an area where I think companies have to be a little bit more vigilant, and they should do some kind of tax diagnostic check. The way we do our health diagnostic, it's important that we also do that and see, hey, am I really going in the threshold? Should I really do some kind of take a step back? Like Rahul has mentioned it, and I think what applies in transfer pricing do also apply in your process on a whole. It's not just about transfer pricing. You still have an option to look into, check where you are are you breaching the thresholds?
Right.
And for God's sake, let's understand, Excel is not technology, and Excel is a very basic thing. There is much more beyond Excel for technology.
Absolutely. So I think and that's all the time that we have for the panel, and I think we were able to probably give some insights in terms of international taxation. I think panelists are available. You can probably ask your questions if there is any in terms of that with the panelists.
I think I'll just add one closing comment.
Sure, definitely.
See, from a litigation management perspective, and it's a larger issue I want to address over here. People feel very happy if they're handling 100 cases. मेरे पास 100 cases है, I have 10 people with me. Please, that's not your job. Close the cases, do a ABC analysis, cases which are not, just don't fight it for the sake of it. Don't increase your workload unnecessarily. Focus on other areas, meteor work. International taxation is much more better. There are a lot of nuances over there. Focus on those aspects. Don't create unnecessary litigations. There was a decision of this Roka bath in Chennai, right? And one of my counsel told me to take additional ground. I said, I'm not taking it. I know my merits. I'll fight it. Let it go against me. Because it will, at one point of time, the decision is going to be turned around by Supreme Court. Reversed. You can't have those 200 cases which are saying that it's a time-barred assessment. No, not possible. So fight on merits. Pay taxes wherever it's possible. Don't keep those litigations. That's my limited point.
I just want to add just two key takeaways, in terms of the assessments, particularly from the transfer pricing perspective. What you can do, particularly on the sales purchase transactions, you ensure that you can take some email correspondence with your sales or commercial team, which generally will be useful after 2-3 years when the assessment picks up. What will happen, because generally the margins will differ, so it will be very easier for you to substantiate with the email evidences, which you can collect it during the year and not after 2-3 years. So that you can do it. And number two, whenever there's a reimbursement or transactions, please ensure that you collect the backup invoices which tally that it's a pure reimbursement and not any service element is embedded, because the transfer pricing method will change and tedious implications will come. So these two things please bear in mind, which you can do during the year itself and not wait for after 3-4 years. Thank you.
Thank you so much, gentlemen. It was not some, but a very insightful session and a knowledgeable talk.